Welcome to the next installment of One Chart in 1 Minute. In this month's episode, we're going to be talking about how corporate failures can provide insight into the health of the corporate credit market. The high yield market is a much maligned sibling of the investment grade corporate bond market. Indeed, for many years it was called the juggle bond market. Companies that issue high yield debt are typically less financially secure and have a higher risk of default. As a result, they pay a higher level of interest rate on their debt in order to appeal to investors, hence the term high yield. When economic times turn more gloomy, this typically has a more negative impact on businesses that issue high yield debt. With their lower and less robust cash flow profiles, they're typically more sensitive to harder economic times. When we look at bankruptcy filings in the US, we can see that there is a high correlation between an increase in bankruptcy filings and a wider spread on high yield debt. What is spread? Spread is the extra premium that a company has to pay over and above the interest that its government pays to issue their national debt. The wider your spread, the higher your spread, the more interest your company has to pay on its debt profile. We can see on the graph attached that weaker economic times are punctuated by the yellow lines on the graph. When spreads widen, we can see here that bankruptcy filings have also increased. Interestingly, since 2023, bankruptcy filings have actually been falling, and that would imply that high yield spreads could potentially fall at the same time, and that would be positive for performance in this particular part of the fixed income market. This is starting to warrant a bit more attention in the multi-asset portfolios here, when we believe high yield could play an important role in portfolios over the next months and quarters.